Goldman Sachs, UBS, Bank of America, Deutsche Bank, BlackRock, PIMCO, Credit Suisse, they've all been writing notes to their clients in recent weeks, warning that a recession has become more likely. But money managers at big banks aren't just talking about a recession, they're betting on it. How do I know? Financial markets have an almost endless amount of contracts, derivatives, and securities that allow investors to bet on just about anything. By reading the movement of some of these securities, we can see how investors are positioning themselves for the future and whether they expect the economy to grow or contract. Here are 4 important market metrics that show how investors are pricing in higher chances of a recession. The first is a brand new metric from the Federal Reserve called the Corporate Bond Market Distress Index, which began publishing in June. Second is inflation break-even rates, which track the movement of inflation-protected securities versus old-fashioned US government bonds. Third is the 5-year forward inflation rate, which looks at shorter-dated bonds in comparison to longer ones. And finally, there's the US Treasury yield curve. They've got some long and complicated-sounding names, but don't worry, I'm going to break them all down and explain why they matter.
Are we at a turning point, headed for a recession?
Yes, the stock market is down, but each one of these metrics follows the bond market, because bond market investors are generally thought to be more concerned with the overall health and direction of the economy than stock investors. The Corporate Bond Market Distress Index, or CMDI, tracks measures of bond issuance, liquidity, and trading patterns to show how fearful investors are. All of those words just mean that the Fed is tracking the flow of bonds. Fewer companies selling bonds and fewer investors buying them typically means trouble, and vice versa. Break-even inflation rates show how investors believe inflation will move over a given period of time. The government sells bonds to investors, and it also sells inflation-protected securities, or TIPS. Break-even inflation is calculated by subtracting the amount that investors get paid for ordinary government debt versus what they get paid to hold TIPS over the same time horizon. This number represents what inflation would have to be in order for investors to break even, or earn the same return from buying TIPS instead of regular Treasury bonds. The higher it is, the higher they expect inflation to be. 5-year forwards are a more nuanced way of looking at inflation expectations in 10 years. They're called that because they look at inflation expectations 5 years from now, and then 5 years after that. The rate also uses TIPS versus regular government bonds, but the point of 5-year forwards is to add a bit of caution to investors' expectations of the future. By comparing 5-year inflation expectations to 10-year inflation expectations, you can throw some water on predictions that are a little too hot or too cold. The Treasury yield curve tracks the rates investors are demanding to hold government bonds that mature at different time periods, from 1 month to 30 years. Shorter maturities should pay less, since loans are more likely to be paid back over shorter time periods. But when that stops being the case, you get what's known as a yield curve inversion. The yield curve is inverted before every single recession since the 1950s. I did a full video breakdown of the Treasury yield curve and its ability to predict recessions in March. Check that out for a deeper explanation. So now that you know what they mean, here's what each of these measures is telling us right now. The Corporate Bond Market Distress Index was elevated in June and is showing some distress in the bond market. Fed researchers found that the index would have spiked during previous times of turmoil, like the 2008 financial crisis, the European debt crisis, and early 2020. The first reading shows increased fear in the bond market, but is well below what we would have seen from the index in 2008. Break-even inflation rates have been sinking in recent weeks, even as inflation readings for this year have been rising. That shows investors expect inflation will be low in the future, even though it's very high today. That typically signals fears of a recession, because a recession stops growth, bringing down the average rate for inflation over time. The 5-year forward rate is even lower, and recently fell to its lowest rate since March. That suggests longer-term growth expectations are really being decreased, which also signals recession fears. And the Treasury yield curve recently inverted. For the second time this year, the yield curve shows investors predict central banks will need to lower interest rates in the future. That's usually because a recession has happened. All of these gauges show that investors are putting more of their bets on a recession, or at least a significant economic downturn. But that doesn't mean it's guaranteed to happen. Rapper YG made a hit song this year by telling us that scared money don't make no money, but sometimes it does. That's all for now. I'll see you next time.